Asia-Pacific banks are moving digital assets to deployment, with 69% already running client-facing pilots and committing infrastructure budgets. To put this in context, we have Ronald Poon of Amina Hong Kong Limited. So, Ronald, are digital assets becoming a competitive necessity for banks in Asia-Pacific rather than an optional innovation?
Hi, Sis. Hi, everyone. It's a great questions. I have been asking this question for quite a number of times for the past few years. But before I jump into that, I'd like to share some interesting findings that I recently came across. We recently came across two set of data that deviate from each other. And I think to me, like the gap between these two, is a key point today that addressed your questions earlier. I recently came across a report from a reputable financial institution from US claiming that their family office, there's like almost 89% of them that has held zero crypto. Whereas there's another report from another financial institutions in US with their survey with the ultra high net worth family office, they found that like there are more than 74% of their clients are either investing or actively exploring. So to me, this differentiate like this between these two, it's in terms of the preparations for those clients. For those clients that have built the infrastructure or they have done the due diligence and even put governance around digital assets, they're moving ahead of others. With those that haven't, are still deliberating. So from my perspective, this discrepancy kind of bring out the message for today, whether like for banks in APAC, whether digital asset matters or not, I don't think this is the question anymore. It's whether these financial institutions or the banks, they're well equipped to serve their client needs. Especially in Asia, this APAC region is where it's playing out fast globally, and which align with the CoinDesk Digital Asset Adoption Index that ranks Asia first across the exchange volumes, stablecoin flows, and ownership rates. And for Hong Kong itself, in terms of digital asset transactions in the first half of 2025, there's an upside of 200% from a year-to-year basis. So when your clients are transacting at this scale, offering no capability as a decision to let someone else to serve your clients.
Now, just for better understanding on this, what exactly does a digital asset ready bank look like in 2026?
I'll look into three aspects from here. I think the first one is whether they are operational crypto capability. So because like for a digital asset bank, they need to have like crypto forensics such as KYC, AML, and even KYT or KYW these days. And they also need to provide like round-the-clock market monitoring, as well as institutional grade custody infrastructure with proper key management. The last but not the least is the API connectivity that plugs into the institutional clients' existing systems. The second aspect I'll look into is technology. I mean, with the help of AI these days, technology ready is a must. But the harder part from my perspective is building the process and with the specialist teams or expertise around it. The last would be whether the bank understand what are they actually holding. For example, like not all stable coins are created equally. And the bank really need to scrutinize what's in those reserves because they are not all the same quality. If the bank could not scrutinize or they fail to do so, the difference between a fully treasury-backed stablecoin and one with a lending exposure in its reserves, they're exposing client to risk that hasn't properly assessed.
On that note, let's say if a bank ignores digital assets today, what does it risk losing over the next few years?
Well, I think like there are two important things that they definitely risk. First one is the client relationships. These days, like no matter it's professional investors or family office, they have been allocating into the digital asset space. So if a bank that cannot facilitate their needs to serve their clientele, there is no doubt that the client will move to the next one or whoever they're able to serve. Let me give you an example. Like Hashkey Exchange, which is one of a regulated exchange in Hong Kong under the BATP regime. With their prospectus last year, they demonstrated they have like over 1.7 trillion Hong Kong dollars of cumulative trading. and which is about like 218 billion US dollars. And with a single license exchange platform, you can imagine that like with this size. So right now we have more than 10 license exchange in Hong Kong these days. And if I look into another report that from Standard Chartered, they found that like there are more than 70% of the Hong Kong family office, they have already invested or actively considering allocating their portfolio into digital asset space. So I think the key question here is not about like being like whether it's being innovative anymore. It's about client retention. And the second aspect I will look into, it's where the bank want to position themselves in a few years' time, given that like right now everyone's talking about tokenizations or RWA under this wave. And then imagine that when stablecoins become the programmable cash layer and the tokenized bond or money market funds become a yield layer alongside them, the banks these days, if they set out or they lay back and they didn't build infrastructure, they would definitely lack of funding to participate. And from my perspective, they would end up as a white label customers of the bank that have been moving ahead or being innovative enough. And for those latecomers, they would definitely take triple or even more efforts to catch the gap.
Thank you so much for sharing your thoughts, Ronald. Looking forward to having you back on the program.
Thank you very much. Thank you, Seth.
Once again, that was Ronald Poon, Executive Director, Asia Pacific at Amina Hong Kong Limited. For more news, visit asianbankingandfinance.net.